Hi, everyone, this is the Encyclopedia channel. The book that this program interprets for you is The Psychology of Money. The author of this book, Morgan Hauser, is a financial columnist for the Wall Street Journal. Hauser likes to discover the unchanging laws of human nature in the vast historical data, and then through these laws, he can see their enlightening significance to the current people. In particular, this money psychology is very beneficial for us to optimize our money decisions and understand the current economic environment. Even understanding some of the principles mentioned in the book is more beneficial than reading many specific investment and financial management guidance books. Points raised in the book, such as, why is reasonable trumps absolute rationality? What do we have to do to keep a margin of safety and survive for a long time? How does a person's past experience shape the way they control money? After listening to this episode, you will understand why. Let's start with an incident in the book. We know that Graham, the investment guru, wrote a book called The Intelligent Investor. This book is called the investment Bible by many people. It not only contains theories, but also provides many practical formulas. The author Hauser read this book when he was young and was exposed to investment knowledge for the first time. He was deeply attracted by the investment formulas in the book, and felt as if he could get rich as long as he acted according to these formulas. However, as his investment experience increased and his understanding of investment deepened, he found that it was impossible to apply the formulas and specific guidance in the book for investment. For example, one of Graham's guidelines is that conservative investors should not choose stocks that trade at more than 1.5 times book value. However, in the U.S. stock market from 2010 to 2020, if you strictly abide by this rule, the only things you can buy are insurance stocks and bank stocks. In other words, the applicability of this criterion is already very poor. Furthermore, if we carefully trace the revision process of the book The Intelligent Investor, we will find that from 1949 to 1972, Graham revised the formulas in the book 5 times. So, by 1972, was it finalized? No, it's just that after this year, his health is failing and he can't change it. Then let's think about it. How much guiding significance will these formulas have in 2023? What about 2050? The specific knowledge and formulas in many investment and financial management books are actually like this, with great time and space limitations. Therefore, the author Hauser believes that we should pay more attention to understanding some things of universal significance, such as the greed and fear in human nature, people's psychological performance in the face of stress, and the psychological repair process after people experience stimulation, etc. Hauser says he likes a quote from Voltaire, "History never repeats itself, but man does." He believes that this applies especially to our behavior with money. So he likes to find the human nature and psychological laws behind it from the history of money, and think about how we can use these discoveries. In this program, we will focus on the 3 reminders he gave us from Hauser's findings. These 3 reminders can be summed up in one sentence. 1. Reasonability trumps absolute rationality. 2. If you want to survive for a long time, you must leave a margin of safety. 3. The way a person spends money is shaped by his past experiences. These 3 sentences sound simple, but when we gradually unfold them, we will discover the mystery. First part. First, let's look at the first sentence. When making decisions about money, it is reasonable to trump absolute rationality. Let's talk about a person first, the 1990 Nobel Prize winner in economics, Markowitz. Friends who know a little about finance should know that this person's position in the field of finance is very important. The asset portfolio theory he proposed in the 1950s put investment in a quantitative framework for the first time, which was called the Big Bang theory of finance. Before he put forward this theory, no one knew how to measure and calculate investment risk. But Markowitz's theory is to transform an abstract concept into a calculable variable. The analytical framework he created can help people calculate an asset portfolio with the least risk and the greatest return. This portfolio can include stocks, bonds, commodities, foreign exchange, and so on. This theory can be said to have created the modern industry of investment analysis. Because before this, people felt that investing was an art. For example, as we mentioned at the beginning, Graham, the father of value investing, is like a master of art who studies individual stocks, but after Markowitz's theory came out, people knew that investment is not just about analysis. The process of a single asset is a process of finding the best combination, which requires a large number of calculations and analysis, and careful calculation. This is also what many Wall Street elites did day and night. Since Markowitz created this theory, he must have done a good job in quantitative investment analysis, right? Did he carefully design a diversified asset portfolio for himself? Someone really asked Markowitz, "How do you invest yourself?" As a result, Markowitz shrugged and said, "Very simple, I bought half of the bonds and half of the stocks." Why did the father of asset portfolio design such a simple portfolio for himself? Markowitz explained, "I can imagine how upset I would be if the stock market kept falling and I put all my money into it, so much regret. So my investment principle is to minimize my future regrets." So this thing is very interesting. There is a saying that don't look at what a person says, but look at how he does it. Markowitz proposed a set of absolutely rational analytical frameworks, which are used by a large number of people. However, when it came to himself, he threw away this framework and used another set of ideas. Why? It was because it was a comfortable and reasonable choice for him. So what counts as a reasonable investment decision for us? Of course, the specifics vary from person to person, but there is a saying in the book that a reasonable investment plan must be a plan that allows us to sleep soundly at night. When investing, the principle is not to let your positions and strategies affect your sleep. And Buffett also said similar things. In 2008, he said at the Berkshire shareholder meeting, "Even if I have to choose, I will never trade a night's sleep for more income." Opportunity. This is also reasonable to him. So, why is it said that in investment decision-making, reasonableness trumps absolute rationality? It's simple, because it makes sense, you can stick to it. Absolute rationality starts from cold calculations, but reasonableness takes human factors into account. And if you want to stick to any strategy, you have to rely on real people to implement it, so we have to consider people's feelings. Just like losing weight, sticking to a healthy diet and exercising every day is very rational, and you will lose weight faster, but at the same time, it is also very painful, and it is easy to give up halfway. Therefore, some fitness coaches will suggest adding a rest day to the week, or an indulgence day, or an extra bite or two of your favorite snack at breakfast each day. A very important reason for doing this is that it makes sense and can help you persist better. But you might say that if some people just like to eat healthy and exercise every day, it's not painful for them. Yes, if so, this way of life would make sense for them. Aware of this, in fact, it is also inspiring for us to formulate investment strategies. You see, many people will say that in the field of investment, it is difficult to adhere to long-termism. When encountering some fluctuations, they can't help but want to withdraw. For this kind of phenomenon, the author gives an interesting explanation perspective. He believes that this is often because we don't like our investment objects or investment strategies enough. For example, you invest in a company because you think it has a good prospect, but you are neither concerned nor interested in its business field. Well, if things go well after investing, you might feel good about it, but when things go downhill, it turns out that you're losing money on projects you're not interested in. Then it's easier for you to turn around and move on to other fields. However, if you are very interested in the investment object from the very beginning and feel that the mission, product, team, and technology of this company are very suitable for your taste, then even if its income temporarily declines or falls into a trough, but because you are interested in it, if your beliefs and love are still there, and you feel that you are at least doing something meaningful with your money, then you are more likely to be willing to stick to it for a while. In addition, you may hear that many professionals will suggest that for most ordinary investors, if they decide to invest in a large-cap index fund, the investment income will be better than going to the stock market by themselves. The author of this book also has this view, and his own family's investment has indeed done the same. However, the author also said that, from a reasonable point of view, this solution is not suitable for everyone. Because many people have their own preferences when it comes to investing. For example, the author knows an investor who mainly invests in diversified funds, but also holds a small number of stocks. He said that he buys stocks not because he thinks which stocks can outperform the market, but because he loves stocks, likes to study stocks, and likes the thrill of following the ups and downs of prices. Holding some stocks is a reasonable choice for him, and it is easier to stick to it. In addition, I remembered that in the book What Father Buffett Taught Me, the son of the stock god Buffett said that since he was a child, he saw his father immersed himself in studying the financial statements of various companies every day to find those underestimated values. Depression, never tired of it. Even though he made a lot of money later and became a stock god, Buffett was still unshakable, wearing khaki pants and working 6 days a week. Because he likes to do these things very much. For others, value investing may be an investment philosophy that requires perseverance, but for Buffett, it is his passion. The author said, "Do what you like. If you look at it alone, you may feel a bit empty, but you use it as a strategy so that you can go better on a certain road. After a long time, you will find that its effect is very magical and powerful." The second part. What we just said is that when it comes to making decisions about money, being reasonable is better than being absolutely rational, which will make it easier for you to stick to it. But what is the point of this persistence? Here, there are 2 direct answers. First, it can increase the success rate of your investment strategy. The author of this book sorted out academic research and found that although scholars have some differences in the measurement of investment return performance, for example, some study the rate of return, while others study the ability of an investment strategy to make money within a certain period of time. However, they showed a relatively strong consistency in a research conclusion, that is, a very important factor affecting the performance of investment returns is whether you can stick to your investment strategy for a long time, even in the economic bad year. For example, some scholars have found that in the US stock market, the probability that an investment strategy can help you make money in one day is about 50%, and the probability of making money in 1 year is 68%. The probability of making money has reached 88%, and if it grows longer, this number will rise. In addition to improving the success rate of investment strategies, persistence has another meaning, which is to allow compound interest to show its power. We all know that compound interest does not depend on huge returns, but on the long-term and continuous accumulation of returns. The power of compound interest only manifests when you give your wealth time to grow year after year. It's like planting an oak tree. It will not change much in 1 year, it will change obviously in 10 years, and it will grow into a towering tree in 50 years. This is what persistence means. From this perspective, the factors that keep you on the field longer are enhancing your advantage. Such factors, we have already mentioned one in the first part, is to make reasonable decisions. In other chapters of this book, I also saw another factor, that is, establishing the consciousness of survival first. The author believes that this awareness is very important, whether it is investing, planning a personal career, or running a business. For example, once, the president of Sequoia Capital and billionaire Michael Moritz, on a well-known talk show, the host asked him, "Why can Sequoia Capital become one of the most successful venture capital institutions?" That's a big question, but Moritz immediately brought up the permanence factor. He said that some venture capital firms' success only lasted 5 to 10 years, but Sequoia Capital managed to keep itself standing for 40 years. The host asked, "Then how did you do it?" Moritz said he thinks this is because they have always been afraid of being eliminated by the industry. Therefore, when they formulate various business strategies and investment strategies, they give priority to the word survival. Each strategy needs to allow the company to live longer and better, or at least, not threaten the company's survival. For example, those options that may have huge benefits, but if they fail, will put the company in an existential crisis, they will never touch. They believe that the most important thing is to survive for a long time and not be eliminated or forced to give up. Buffett also said similar things. An important secret to successful investment is to don't play at the poker table. That is, at least ensure that you can survive. If you stay alive, you have more chances to win. The story of the pair of Buffett and Charlie Munger, in fact, when they first founded Berkshire, there was a third member of their combination named Rick Gellin. Then why did this person disappear? It turned out that during the US recession from 1973 to 1974, Rick saw an investment opportunity, so he increased leverage and borrowed money to invest. In the end, it turned out that Rick had made a mistake in his judgment. He lost a lot of money and could only sell his shares in Berkshire to Buffett at a low price. In this way, he left the table and failed to share in Berkshire's subsequent gains. Regarding this matter, Buffett later said, "Charlie and I always knew that we would become very rich, but we were not in a hurry to become rich." Rick was as smart as us, but he was too impatient. From the story of Rick Lin and Sequoia Capital, we can also summarize an inspiration, that is, if we want to put the concept of survival first into practice, we must first remember that there is no the gains are worth the risk of losing everything. This is also a sentence that is emphasized in this book. From Buffett's own investment strategy, we can actually see this very clearly. He always kept sufficient cash in the company's accounts, never increased leveraged loans for investment, and often sold assets and held cash when asset price bubbles just emerged. For example, during the financial crisis in 2008, Buffett not only did not lose money, but also made a lot of money. Why? It is because before the crisis broke out, he thought stocks were expensive and hoarded a lot of cash. After the crisis, he picked up a lot of cheap assets, so he made a lot of money. You may ask, if so, are you not afraid of missing opportunities? Buffett's view is, don't be afraid. There will always be opportunities, but it's important that you make sure you stay at the table first. In the book Return on Capital, the long-win company Marathon in the field of asset management insists on the concept of stay away from bubbles, even if it is too early, which actually has a similar meaning. What we just said is that to put the concept of survival first into practice, we must remember that no gain is worth the risk of losing everything. In addition to this, there is another reminder in this book, that is, if you want to survive for a long time, you need to leave a margin of safety. Margin of safety is a concept put forward by investment guru Graham. The author of this book believes that this is a very intelligent way of thinking that deserves our attention. What does margin of safety mean? Very simple. For example, if you think a company is worth $10 and its current market price is $9, you decide not to enter the market and wait a little longer. 2 days later, the market suddenly gives a price of $7 and you decided to enter. Then the $3 discounted from $7 compared to your expected $10 is the margin of safety in your heart. Keeping a margin of safety means setting this number as large as possible. For example, it is still this company, you think it is worth $10, and then you enter the market when the market price is 9 yuan. But then the market price dropped a lot, down to $6. At this time, your mentality may be very unstable. But if you leave a little more margin of safety and enter the market with $7, the loss will be much less. If you keep a little more, you may not have entered the market yet, so there will be no loss. Therefore, in investment, leaving enough margin of safety can be very straightforward. For example, no matter how much you value a company, it is best to give the number in your heart another 50% or 40% off, and wait until it reaches this low point before considering buying this stock. This is what many value investors have learned for many years. The experience gained from rolling. Of course, the idea of leaving enough margin of safety is not limited to investment. For example, in terms of personal financial planning, the author gave an example. If you expect your annual investment income to be 8% in the future, should you use this figure to make plans for your future use of money? Better not. A better approach is to make a discount on the basis of expectations, so that the plan you have made can be realized even when the rate of return is only 4% to 5%. In life, there are many forms of margin of safety, such as a looser schedule, flexible plans, contingency plans for unexpected situations, and a budget that always has a surplus, etc. The author said that in many cases, our plans fail to be realized not because we have misread the direction, but because we have not left enough margin of safety. It's like many people are right about the long-term trend of stock prices, but because they don't have enough reserve food on their books, they fall into short-term fluctuations. In short, in a world full of uncertainties and black swans appearing from time to time, no one can guarantee that their predictions are always correct. And leaving enough margin of safety is to leave enough room for fault tolerance in our survival. Even if you make some mistakes, you will not leave the field in a disastrous defeat. The third part. Above we talked about the two reminders given to us by this book, namely, reasonableness is better than absolute rationality, and, if you want to survive for a long time, you must leave a sufficient margin of safety. In the next section, let's talk about the third reminder, which is very helpful for us to understand the behavior of others and changes in the environment, That is, the way a person spends money is shaped by his past experience. It is common in life that experiences shape us. For example, people who lived a hard life and didn't eat well when they were young tend to be more interested in eating when they grow up. People who have been betrayed in their relationship tend to be more cautious and suspicious towards their partners, and so on. In the treatment of money, the shaping effect of experience is also obvious. For example, the study found that those who made money as soon as they entered the stock market were less willing to cut their meat and stop losses when they encountered losses later. It is easier to admit that you are wrong and stop the loss in time. In 2006, two economists from the National Bureau of Economic Research took an in-depth look at the way Americans manage their money. They found that people's investment decisions throughout their lives are largely determined by their life experiences, especially in early adulthood, that is, in their 20s. This is also relatively easy to understand, because people in this age group have just dealt with money issues independently and have just established a perception of the external economic environment. For example, the two economists found that if a person's economy had a high inflation rate when he was young, he would invest less in bonds later in his investment career. When the stock market is booming, then he will invest more money in stocks in the future investment career. The Financial Times once interviewed a well-known bond manager named Bill Gross. If he had been born 10 years earlier or later, Gross said, he probably wouldn't be in the job he is doing. Because when he was young, he just caught up with the sharp drop in interest rates, and the price of bonds soared. This has greatly affected Gross' views on investment opportunities. In his view, bonds are money printing machines. But Gross's father, who belonged to a generation that grew up in a high inflation environment, saw bonds not as money printing machines but as wealth shredders. Speaking of this, we have used some examples to further understand that the way a person spends money is shaped by his past experiences. So, what practical inspiration can this sentence give us? I think it's these two sentences. The first sentence, what seems incredible to you may be reasonable to others. From the narration just now, we should be able to clearly feel that different people are born in different ages, have different growth experiences, are in different social and economic environments, and even have different luck, which will cause them to have different opinions on investment and money. Perceptions and attitudes vary widely. Because of this, sometimes we may feel irrational when we see someone else's wealth decision, but in fact, from the perspective of his own experience, it may be reasonable. Also, if you try to persuade him to change his mind, it may be difficult, because everyone is more willing to believe their own experience than other people's persuasion. The author believes that when it comes to money, few people really lose their minds, but the sense of each of us is different. There is another inspiration, which we can derive from this part of the book, that is, the environment is a fast variable, but the human heart is a slow variable. People who have experienced earthquakes or floods will be more cautious. People who have experienced recessions will be more inclined to reduce consumption and increase savings. People who have experienced bankruptcy and unemployment will be less willing to take risks. Shocks of change come and go, but the imprints it leaves on a person's mind are long-lasting. In the late 1990s, before and after the Asian financial crisis, it was observed that the cash-holding ratios of companies in 8 East Asian countries all increased rapidly. Why? Because cash flow is king, is the experience entrepreneurs have learned in the crisis. And 10 years after the crisis, the proportion of cash held by companies is twice as high as before the crisis. Is this because people in East Asian countries are more conservative? No, East Asia is not a special case. Similar things have happened in many countries around the world. For example, after the 2008 financial crisis, the savings rate in the US continued to rise for 10 years, in the UK for 6 years, and in the EU for 4 years. A financial scholar called this the scarring effect. Because the human heart is a slow variable. The scars of a huge economy are formed by the gathering of the scars on the hearts of countless micro-individuals. Shock comes and goes, but it leaves a scar that takes time to repair. In such a period, people in the economy, while repairing their inner wounds, undoubtedly need to adapt to the repair period of the external environment. How to adapt? For example, personal investment decisions should adopt the idea of guaranteeing the bottom line and diversifying allocation. Diversified allocation means, where possible, to make your asset classes, currencies, investment periods, and investment methods more diversified. Guaranteed thinking means that part of the assets should be used to guarantee the bottom, and we should not make too many trade-offs in terms of income. For example, around 2022, some people have bought a lot of physical gold and guaranteed insurance products. These decisions are not for profit, but for guaranteeing the bottom line and building a safety net for personal wealth. Furthermore, for example, in terms of business operations, in a period of decelerating growth and heightened uncertainty, blindly pursuing the expansion of the scale of the enterprise is likely to be large but not strong. The species that do well during such times are probably not behemoths like dinosaurs and whales, but intelligent species like house sparrows that can quickly find new ecological niches. In short, in an environment that has experienced shock and is repairing scars, whether it is a city, a company, or a person, it needs the power to heal. And what we can do is to uphold a tenacious heart to understand the new climate conditions and new soil environment, to adapt, to survive, and to evolve. Although the heart is slow, time is long. The above is the key content of the book, The Psychology of Money. We hope that our explanation can help everyone understand wealth, people's hearts, and the economic environment we live in. This is the end of this episode of the show. What do you think about it differently? Welcome to leave a message to discuss with everyone. Hey, if you like our channel, please subscribe us. Haha, remember to like it.